Welcome back. Mortgage rates on Tuesday, which is today, increased to the highest levels since November of the year of 2000. So a 23-year high regarding average rates today, which again is for people with exceptional credit. I'm going to explain that, but also I'm going to show how or why rates increased on Tuesday, but also the impacts regarding current home buyers right now, but also the overall housing market in the weeks and months ahead as well. So I have a lot to share in today's video. Let's go ahead and dive right in. This is according to CNBC, the 10-year treasury note or the yield on that is tied loosely to mortgage rates. So it increased by about 12 basis points today to nearly 4.8%, just absolutely crazy. This is actually the highest levels going back to the year of 2007. So because the treasury increased today so much, going to 4.8% right now, it's just absolutely crazy. The average mortgage rate, according to Investopedia.com, increased to 7.98% for a 30-year fix. Also just doing a quick Google search right now for a loan balance of $400,000, putting 20% down with a FICO score of at least 740 to 759. Your average rate is just over an 8% rate, which by the way, a FICO score above 740 typically gets you the best interest rate for your loan here. When you decrease this though to, let's just say 700 to 719, it increases to 8.4%. Below that to 660 to 679, a whopping 8.6% 30-year fixed rate mortgage. Also, according to the Mortgage News Daily as of today, which is October 3rd, your daily rate just increased to 7.72%. Again, a friendly reminder here, this is people buying their primary residence. In other words, they're not buying an investment property. On top of that, this is for people with exceptional credit, a FICO score of over 740. On top of that, this also implies you're going to put down 20%. If you're putting down less than that, your rate could be higher than this. Absolutely insane here because this is an increase of 11 basis points compared to yesterday. And also for a jumbo, we're at 7.75%. And FHA is at 7.15% and VA at nearly 7.2%. And again, this 30-year fix right now, the highest levels going back to November of 2000. So I first want to share why did rates increase so much today, but also going to talk about the impacts regarding current home buyers right now. I'm going to share some jaw-dropping stats to share how your average monthly housing payment right now, how that compares to 4 years ago, back in August of 2019, because the trends are just absolutely insane. Anyways, I'm sharing this because this is a very much a forward-looking indicator of home buying demand and of course our housing market as well. So why did rates increase so much today? Again, increasing by 11 basis points to 7.72%. I just can't get over this. Here is what happened though, because we had a report which is called the JOLTS report. This is actually from the U.S. Bureau of Labor Statistics. It is what's called their Job Openings and Labor Turnover Survey, or the JOLTS report. This is a measure of the amount of job openings on a monthly basis in the United States here. So here's what happened here. Because their forecast was 8.8 million, it actually came in at well above that at 9.61 million. But not only did the actual numbers come in well above the street's forecast here, it also was a fairly big increase this August compared to July. So not only was it a giant increase compared to what the street was forecasting, but also this was a fairly big increase, up by nearly 700,000 more job openings compared to July this year. That's because back in July, as you can see right there, there was 8.827 million job openings, then increased now in August to 9.6 million. Also, something I found to be interesting here is that it was decreasing for 2 consecutive months here, actually 3 consecutive months. but now it increased to much higher than the street's forecast here. So the Fed is not going to like this because they want to see the labor market slow down and see fewer job openings nationwide here, which will imply that fewer people will have money to spend, which will decrease inflation numbers. This is telling the Fed the exact opposite is happening right now, increasing well above the street's forecast of 8.8 million. So what does this all mean for our housing market and of course for rates as well? Anytime we get good news regarding our economy, it actually decreases mortgage rates or actually increases rates because this implies our labor market is actually more stronger than we need it to be because we want to see, or the Fed wants to see, the labor market slow down, which will imply that inflation will also decrease as well. And therefore, because the Fed is going to view this as a labor market being stronger than they want it to be, this will likely cause rates to be higher for longer. Let's have a look at mortgage rates according to the Mortgage News Daily. Again, increased to 7.72%, the highest levels since November of 2000. 1 year ago at this time, we were at 6.69%, an increase of 1.03 percentage points over the past 1 year. I was going to say 3 years, 1 year. What I found to be just absolutely wild is that back in September 29th, just 3 business days ago, rates decreased 16 basis points to 7.44%. But over the past 2 days here, getting absolutely destroyed. Increasing 17 basis points yesterday, and now today increasing 11 basis points. What is that? A 28 basis point increase over the past 2 days alone. All right, I want to share an example regarding how current home buyers are being affected by these rising rates, especially compared to 4 years ago. I tend to talk about changes compared to 1 year ago and also 2 years ago, but I also want to share how the monthly housing payments and all these headwinds that home buyers are facing right now compares to pre-pandemic levels back in August of 2019. And the stats I'm sharing right now are going to be absolutely mind-blowing. At least I was just blown away by them because I've been talking about how rates and prices have been increasing fairly substantially over the past 2 years, but over the past 4 years, it's just absolutely mind-blowing. So here is a look at the median sold price in August of 2019, according to the National Association of Realtors. So this is your median sold price nationwide 4 years ago. Let's assume back then you put 20% down. Your mortgage rate back in August of 2019 was around 3.6%. Just like my previous videos, I'm excluding insurance and taxes and HOA because that varies widely in the area and frankly the state as well. So only looking at the changes in prices and of course the increases in rates in today's video here. So look at that. Your principal and interest payment would be $1,014 per month. That's principal and interest. But look what happens when we look at today's rates as well. So looking at the median sold price as of August, the most recent data we have from NAR, that's $407,100, putting 20% down, and your interest rate today at 7.72%. Your new housing payment would be a whopping $2,326 per month. That's absolutely insane. So prices increase from $279,000 to $407,000, but also your rate increased from 3.6 to 7.7%. Therefore, your new housing payment just increased a whopping $1,312 more per month to buy a median price home today compared to 4 years ago. That's a whopping 129% more compared to 4 years ago. So take a step back here. If you're a home buyer looking to buy a median price home today compared to 4 years ago, your housing payment just increased by 129%. Just absolutely crazy. One thing I want to share is because I would say this is not sustainable, right? Because incomes have not increased by 129% over the past 4 years, not even close. So here's our good Uncle Fred here, and the source here is the U.S. Census Bureau. This is a look at the median family income nationwide. So back in 2019, they don't have monthly averages here on this website, but back in 2019, for the year as a whole, your median family income was $86,010. Now, fast forward through 2022, the most recent data we have, the family income increased to nearly $93,000. By my dumb math, that's only an increase of 8% over the past 3 years, compared to this 129% increase in your average monthly housing payment. And that, by the way, excludes the increases in property taxes and, of course, insurance that you would have paid due to prices increasing, of course, due to insurance premiums also increasing over the past 4 years. So that percentage of an increase of 129% is likely much higher than that due to insurance costs and, of course, property taxes also increasing as well. So that's number one. I'm going to call this the quadruple whammy that home buyers are facing right now. That's number one. The median sold price increased by $128,000 over the past 4 years. That's an increase of 46%. Going from nearly $280,000 to about $407,000. That's number three, or number two, I should say. Number three, rates more than doubled over the past 4 years as well, going from 3.6 to 7.7%. That's an increase of about 4.1 percentage points over the past 4 years, which causes buyers' purchasing power to decrease by about 41% as well. That's number three. But here's your quadruple whammy here. You're going to pay a lot more in interest paid over the life of that 30-year fixed rate loan. When your interest rate was at 3.6% and also your home price there, your purchase price was about $279,000, you're only going to pay $142,015 in interest paid over the life of that 30-year fixed rate loan. Look at this though. This just absolutely blows my mind here. Your interest paid over the life of that 30-year fixed rate loan, taking into account prices today and also rates today, is a whopping $511,847. Nearly $512,000 in interest paid over the life of the loan, which is actually much higher than your original purchase price of only $407,000. Compare that to only $142,000 when looking at rates and prices from 4 years ago, which is much less than your original purchase price of about $279,000. This equates to a whopping $370,000 more in interest paid because prices and, of course, rates have been absolutely skyrocketing since August of 2019. So you may be asking yourself, what does this all mean for a U.S. housing market? Let's first talk about the federal funds rate, which is the rate that the Fed controls. This is the CME Fed Watch tool. This is the likelihood that the Fed will change their rates in upcoming meetings here. Their next meeting is in 28 days, which is in November 1st. And then there is a strong likelihood that the Fed is going to pause any further rate hikes in their next meeting. In fact, by a 69.1% probability. You have to go all the way through July next year to get to a probability, more often than not, that the Fed is actually going to decrease rates. So let me just share June 12th. So June 12th, there was a 38.7% probability that the Fed will keep rates at 5.50%, the same rate we have today. So rates longer than anticipated, or longer than was previously anticipated. Then their next meeting, which is July 31st, a 34.4% probability that the Fed will decrease rates by 25 basis points. I'm sharing this because the street is not expecting the Fed to pivot anytime soon. In fact, they're not forecasting for a Fed pivot until we hit July 31st next year. Of course, a lot of incoming data will be coming until then. And of course, this is ever changing, but that's what we know today. So one more thing I want to share in today's video is this right here. This is my own analysis regarding the National Association of Realtors seasonally adjusted annualized rate of existing home sales. That's a tongue twister. More or less, this means what is the current pace of home sales of existing houses, excluding brand new home construction. I want to share this with you guys because My predictions is that because we're at such low levels of existing home sales right now, and also new home sales also decrease in August, we'll likely see fewer decreases in the months ahead here. Because a realization I had this morning was in August, the current sales pace was just over 4 million home sales. That was the seasonally adjusted annualized basis of closed home sales at just over 4 million. That's the lowest pre-COVID levels since November of 2010, and also very close to the lowest levels or lowest sales pace since October of 2010. In fact, besides October of 2010, the last time we had levels this low was back in January at 4 million even. I mention this because this is data for August, where in August, we tend to see a fairly high amount of home sales. So to say that we have nearly the same number of home sales in August compared to January this year is very much eye-opening here. So I would imagine that we're going to have seasonality where sales tend to decrease as we approach the holidays. But on top of that, we have rates over 7.7% right now, which would likely cause home sales to decrease further. I would not be surprised at all to see this number once they announce September's stats in about, I think it's about 2 or 3 weeks from today. I would imagine this number is going to be in the threes. And the last time we had the sales pace below 3 million, actually, I don't even know. Let me just see how far back I have to go in order to get to less than 4 million. And it's right there. October of 2010, when the sales pace was 3.83 million. So in other words, home sales are virtually crashing in the United States right now due to a lack of housing affordability. Prices are still much at very elevated levels. And of course, rates very, very high as well. So my personal opinion is we'll see a huge pullback in sales in the months ahead through January and February next year. On top of that, it'll take longer and longer for houses to sell. And just keep in mind, this will probably increase housing inventory longer than it's anticipated. Inventory levels tend to peak around mid or late summer months in around August. But right now, at the time of filming this video, which again is in early October, inventory levels nationwide is still increasing. So I would imagine because buyer demand and sales will be falling in the months ahead here, we'll likely see inventory still increasing or peaking later than what's normal. And keep in mind, this is not due to a surge of new listings. This is really a demand problem in which fewer contracts are being signed. Of course, we're seeing fewer closed home sales. And therefore, as more homes get listed for sale each and every day here, it increases inventory levels in the weeks ahead here. What I will say though is that we're not seeing a huge pullback in prices so far though, because relatively low levels of inventory, still down by about 45% compared to pre-COVID levels, is still supporting home prices so far. But again, inventory is still increasing. Of course, there's a lot of headwinds that our housing market is facing right now. So that's my biggest takeaway from today's video. But I would love to hear from you guys as well. What do you guys think about today's video and my analysis regarding the huge increase of 129%? I don't know how many people can afford to pay $1,312 more per month to buy a median price home today compared to 4 years ago. Sad but true. That's definitely true. I would say that for everyone who's frustrated regarding your housing market, I am one of those people as well, even though I'm a homeowner, because I would say trends we're having in our housing market right now, or the trends I'm seeing right now, is definitely not sustainable and something has got to give. When that'll happen, it's anyone's guess. But thank you so much for watching today's video. Please like and subscribe. I appreciate you, and we'll see you on the next video.